Welcome back to Digital Cashflow Global. Today we are diving deep into the engine room of online profitability, mastering e-commerce cash flow. Too many stores focus only on revenue, but true success lies in managing the flow of money. This 15-minute breakdown will cover the essential evergreen strategies to optimize your working capital, reduce payment friction, and ensure a consistent cash reserve for growth. Let's start with the fundamental difference. Revenue is not cash flow. Revenue is the total sales amount recorded. Cash flow is the actual movement of cash in and out of your business bank account. In e-commerce, the gap between the two can kill you. The first critical area for optimizing your cash flow cycle is inventory management. If you sell physical products, overstocking ties up crucial cash in unsold goods that sit on a shelf instead of working for you. The goal is lean inventory. Implement just-in-time ordering where feasible, or use accurate forecasting software based on historical data and seasonal trends. If your software predicts a slow period, reduce your purchase orders drastically. Conversely, understocking means lost sales and frustrated customers, which indirectly hurts cash flow by damaging lifetime customer value. Your inventory levels must be a direct reflection of your short-term cash position and your sales velocity. Look closely at your inventory turnover rate. A higher rate means your cash is being recycled faster. The second pillar is managing payment terms and float. In e-commerce, your cash float is the time between when a customer pays you and when you have to pay your supplier or cover advertising costs. We want to maximize this float. Customers typically pay instantly via credit card or payment processor, but you might have net 30 or net 45 terms with your primary supplier or manufacturer. This delay is your friend. If you can negotiate better payment terms with suppliers, you effectively get a free interest-free loan, which boosts your immediate cash position. Furthermore, review your merchant processor fees and payout schedules. Some platforms hold funds for several days. Explore options that offer faster daily payouts, even if the transaction fee is marginally higher, as instant access to cash can be worth the small premium. The third essential element is advertising spend optimization. Ad spend is the largest outflow of cash for most scaling e-commerce brands. If your ad spend isn't converting efficiently, you are essentially taking cash out of your account and throwing it away. You must ruthlessly track your customer acquisition cost, or CAC, against your customer lifetime value, or CLV. A healthy business maintains a CLV that is significantly higher than the CAC. If your CAC creeps up due to market saturation or platform changes, you must immediately pause scaling until you find new profitable creatives or audiences. Automated budgeting tools within ad platforms are helpful, but never set and forget. Regularly audit your ad spend to ensure every dollar is contributing positively to the cash flow cycle, not draining it. Now let's talk about handling returns and refunds. Returns are inevitable, but how you process them affects cash flow. A slow refund process frustrates the customer, potentially leading to chargebacks, which are the absolute worst for cash flow because they reverse the transaction and often incur a fee. Streamline your return authorization process. Once you receive the returned product and confirm its condition, process the refund immediately. A fast, professional refund experience turns a negative situation into a trust-building moment, protecting your future cash flow from chargeback fees and negative reviews. Moving into growth strategies. Pillar 4 focuses on scaling with debt versus cash. Scaling requires capital, but how you acquire it matters immensely for cash flow health. Using business credit lines or short-term working capital loans to fund inventory, only when you have clear, proven sales data, is smart. This is leveraging cash flow that you know will be generated by the inventory you are buying. What is dangerous is taking out a loan to test a new product line or a new advertising channel. That puts your entire existing cash flow at risk. Growth fueled by debt must always be tied to a high probability, short-term return cycle. A crucial, often overlooked area is managing subscriptions and recurring revenue. If you sell any subscription box, recurring consumable product, or SaaS tool, you must aggressively monitor your churn rate, the rate at which customers cancel. High churn means you constantly have to spend more on acquiring new customers just to stay flat. Focus your automation efforts not just on sales but on retention. Implement win-back campaigns for failed payments and proactive customer service check-ins for long-term subscribers. Consistent subscription revenue is the most predictable form of cash flow you can build. Let's briefly touch on global expansion and currency risk. Selling globally introduces currency fluctuations. If you sell in euros but pay suppliers in USD, a shift in exchange rates can suddenly erode your profit margin, severely impacting your expected cash flow. Utilize tools that allow you to lock in favorable exchange rates or hedge against major currency movements if you are dealing in high volumes across multiple continents. Ignoring currency is leaving easy money on the table or opening yourself to unnecessary losses. Finally, to ensure stability, you must implement cash flow forecasting. This isn't just looking at last month's bank statement. You must forecast 90 days out, factoring in expected seasonal spikes, scheduled large inventory purchases, upcoming annual software fees, and planned marketing spend increases. A solid forecast lets you see potential cash shortfalls months in advance, giving you time to secure financing or delay non-essential spending, rather than reacting impulsively to an emergency. To summarize the path to consistent digital cash flow through e-commerce: master inventory turnover, aggressively maximize your payment float, keep CAC tightly controlled against CLV, handle refunds professionally to avoid chargebacks, use debt judiciously for proven scaling, fight churn relentlessly, manage currency risks, and always maintain a forward-looking 90-day cash flow forecast. These principles remain the bedrock of profitable online business, regardless of the platform or the year. Start optimizing these levers today. If you found this deep dive into the mechanics of e-commerce cash flow valuable, please hit the like button. Subscribe to Digital Cashflow Global for more timeless strategies that build real wealth. Let me know in the comments. What is the biggest cash flow drain in your current online business? Thank you for watching, and I'll see you in the next video.